Welcome back to another episode of Providence Money Wisdom Podcast. I'm Evelyn Goh, Deputy CEO and Chief Advisory Officer at Provident, and today we have a very special guest. He is none other than Mr. Dave Butler, Co-CEO of Dimensional Fund Advisors. Hello, Dave.
Hello,
Thanks
Evelyn.
for being with us today.
Thank you very much. Great pleasure to be here.
Right. The limitation of a podcast is, we don't get to see the visuals. And if you do get to see us, you will see that there is a huge difference in terms of height between the two of us. Of course, he's seated. It's not so obvious. But Dave is actually very, very tall. Now, Dave, can you just tell us how tall you are?
Yeah, so I'm 6'8", which I think translates to about 2.05 meters, something.
Yeah, I actually did a check. You're
did you?
2.06 meters
there
tall.
you go. Okay, yeah.
So that's like more than half a meter taller than me.
Yeah.
That's really tall.
They always listed me in meters when I played basketball in Europe, so that's how I remember.
Because in
States,
Singapore, that's the kind of matrix we use, right?
Yeah.
So we understand that you were a professional basketball player prior to joining the finance industry. Why make the switch, from being a professional sportsman to the finance industry? Maybe you can share with us a bit of your journey.
Sure, happy to. Yeah, I played college basketball in Berkeley, in California, and then I was drafted by the Boston Celtics. And the year I came out of college, they had a strike, so I wasn't allowed to go try out with the Celtics. So instead, I decided to go out to a team in Turkey, Istanbul, Turkey. So that was my first year in professional basketball, was in Istanbul. And then the following year, I went to Tokyo, to Japan, and played a year there. And then went back to get my MBA at Berkeley. So I was always a finance person. And when I was playing basketball, I always thought I'd be a professional in the NBA and play in the U.S. But unfortunately, the strike was there, and then I ended up hurting my calf, my Achilles, when I was in Turkey.
Oh no!
And so that sort of progressed me towards moving away from sport and basketball and back into academics, into my finance career.
I see. And what led you to joining Dimensional?
Well, that's a good question, long question. When I finished up in playing ball in Europe. I had this opportunity to go and be in New York, and I went to Wall Street for my first career, started my career journey, and that was at one of the big investment banks, and I was on the trading desk there. And I was probably 3.5, 4 years into my time at the bank, and just wasn't really inspired by what I was doing. I wasn't inspired by the environment at that time, which was very transaction and commission oriented. It was not a scenario that was good for clients, in my view. So I had made a decision that I was going to go back to California and go be a high school teacher and a basketball coach, and just leave the industry completely.
But that would be a waste.
Yeah, and luckily I happened to see a Wall Street Journal ad in the bottom corner of the 17th page, and it said Santa Monica, California, and I'm from California. So I liked the idea of going back to California, and I sent a resume in. And it happened to be a resume that was sent to Dimensional Fund Advisors. And my mentor, who became my boss, a guy named Dan Wheeler, pulled my resume out of the stack and liked what he saw on the resume. And I had a CFA, and I was an MBA from Berkeley. And he had started his PhD in accounting at Berkeley.
I see.
So that was the connection there.
Right.
He invited me in to interview with Dimensional, and it was just a fabulous day for me. It was what I call the aha moment, where I come off the elevator and I got to meet David Booth.
Wow.
And David,
the founder, right?
The founder, yep. And David walked up with Merton Miller, and Merton Miller was a board member and a Nobel Prize winner. And then David asked Dan if he would be willing to take Merton to lunch, because David had other plans. And so Dan took Merton Miller and myself out for lunch. That was my first interaction with Dimensional, and I just remember.
And that was actually your interview day.
That was my interview day. Yeah,
wow.
My first day, and I remember, just how amazing Merton Miller was. He was just so modest and funny and smart, and he said some things at the lunch that I just it finally woke me up to what I thought was the right answer in finance and in personal investing. And he said three things. He said, markets work. He said diversification is your buddy. And he said, costs matter. And he says, if you can think of those three things as an investor, you're going to be very, very well off. And I remember walking away from that lunch and thinking to myself that what I just heard was sort of that transformative moment, that aha moment that I thought, okay, I can be in this business, in the financial services business, and feel good about what I was doing, and also, enjoy kind of my day-to-day work. I feel like I'm making an impact on clients and on retirements, on people's wealth and so forth. So it was really a wonderful day for me because I literally had decided to leave the financial space completely and go be a teacher and coach, which I love. But then I had a chance to join Dimensional, and I'd say the last 28, 29 years I've been at Dimensional, it really is a chance for me to educate, to train, to really act as a teacher, but in the financial services space in a very different manner from what I had seen my first few years in the business when I was in New York.
Yeah, I'm sure your staff at Dimensional is very glad that that interview worked out well for you.
Yeah.
So it's been 28 years and counting that you've been with Dimensional. So obviously, some parts of the company could be the values, could be the culture, must have resonated with you. Could you share with us what some of these are?
Yeah, I think it's the people. I think, I mentioned Merton Miller and just the modesty and, what I would call the pursuit of truth. So I was very, very comfortable with the people I met at Dimensional, and every one of them, in my mind, is the highest integrity, a lot of modesty for the level of intellect that we have at the firm. But the main point and the main thing that really resonated for me was it was really all about the client and about the experience of the client and how do we make that experience better. And the norm was high transactions, high commission, high cost, high turnover, all the things that we would agree that is a negative for the end investor and for their experience as an investor. So this was just the opposite of that, a completely different model. We call it a redefinition of investment advice, redefining investment advice. And that redefinition is one where the advisor, again, is working as a fiduciary to the client, and the asset manager, in this case Dimensional, builds the most efficient access points to the capital markets as possible. And then the advisor on behalf of the client decides what portfolios that they're going to put the client in. They know the client better than Dimensional does as the asset manager. So the model just made a lot of sense. And again, it was an idea that really had not much traction and not many assets. And as I look back 30 years later, the industry has been impacted in a major way, and it's changed completely. So everything, when you look at the U.S. advisory business, is very much around the kind of idea of fiduciary, independent advice, holistic wealth management, all of those concepts that weren't part of our description of advice 30 years ago are now right down the middle of the road and very mainstream and very accepted throughout the U.S. and I think throughout the globe now as well.
Yeah. Right. You mentioned about low cost. Indeed, that's one of the big characteristics of the funds of Dimensional. I mean, and we are talking about 0.2 to 0.3 per annum for an actively managed fund. That's compared to what we have here. We're like looking at least 1%, 1.5, if not 2%, for a fund's annual management fees. Could you share with us how Dimensional managed to keep your cost low for investors?
Yeah, I think the environment at the time, and as you mentioned, 1.5% to 2%, that's oftentimes active management and the idea that markets aren't efficient, that prices don't reflect information, that me or somebody else is going to be able to go into the market and find the right stock and then put investment into that stock.
Business trips to visit factories.
Factories. So there's a lot of expense that comes with that model.
Yeah.
The reality is, and the data I've looked at for 50 years, and obviously the academics who have been much more studious of that information, just suggested that's not a real activity that's going to be added value over time. So the data going back 50 years says, prices reflect information, markets are efficient. It's very, very difficult for an active manager to make those kind of stock and selections and market timing selections that are going to add value. And so it doesn't make sense to have a investor pay 1.5 or 2% for that activity. So then you come back to, okay, you can make it cheaper. As I mentioned, Merton Miller, when I first spoke to him, cost matter. Yep. For your end return, costs do compound, and they are very costly to investors if that high of a cost. But at the same time, Dimensional's approach is we think we can add value above the market. So if you're able to identify through research, identify areas of the market that have higher expected returns, as you know, small caps, value stocks, profitability, et cetera, you're able to actually then position your capital in the market across those spectrums of returns that are higher expected returns. And then you're able to implement daily so that you're constantly exposing yourself to the higher expected return areas of the market. And that's a great outcome. So we often say, if Dimensional was an index fund, just a low-cost index fund, we wouldn't have a business. We add value. We take all the best of indexing, which is low cost and low transaction costs and low turnover and tax efficiency. And then we add on to that this idea of implementing in a daily fashion that allows the investor the best, most efficient access to the capital markets and gives them a chance to beat the market without outguessing the market. And that's the whole kind of crux of what we've created at Dimensional and I've been lucky enough to be involved with for the last 30 years.
In fact, one of the story that I heard, right, about how cost conscious or how conscious you are in terms of like saving cost is your choice of location of your head office in Texas. Yeah, maybe you want to share with us a little bit about that story with our listeners.
Yeah, I think it's an important point. We think of ourselves as fiduciaries, and we want to deliver the greatest return possible for the investor. And when you think about what you need to do that, you need to have a staff that's able to deliver that. So our research staff, our portfolio management group, there are over 100 people focused on one philosophy, focused on the ability to daily implement in a very, very efficient fashion. So you need to have a lot of focus and energy on that. And it's not a simplistic default kind of rote mechanism of an index fund. It's more than that, and that's the value add with Dimensional. So back in 2003, we were a $50 billion U.S. dollar asset manager. The idea that was based on our growth pattern, we would be a $500 billion manager by 2018. And so the move to Texas was to reflect that. We figured if we needed to be a fiduciary and do the right thing for the clients and have the right infrastructure to be able to build out the right fund lineup for clients, we'd have to do it in a pretty significant increase of employees over that time. So moving to Texas allowed us to do that. And it was a planning process to really just reflect the fact that we are fiduciaries, just like the advisor is to the client. And in our fiduciary view, we felt the best move was to be in Texas, allowed us to expand the employee base in a way that we thought would reflect the ability for us to act as a fiduciary in the highest manner on the $500 billion. Today we're $630 billion, so we've kind of moved past that $500 billion mark.
Congratulations.
Thank you. But it's been a very successful move for us. And again, all of this is really built around the idea, like, what is the best thing that we as Dimensional can do for the client? And that's to deliver these portfolios that are going to be very, very efficient, and then work with advisors who are going to be able to have a expert knowledge on the client, and then again combine those two and really deliver a great client experience.
Thanks, Dave, for sharing about your decision of expanding and discharging the fiduciary duties to the investors. Just now you mentioned also that Dimensional has this different way of working, and that's to choose to work with independent financial advisors. And 30 years ago, that's really very uncommon. In fact, that's very distinctively different. So what caused Dimensional to choose to work with IFAs? And I think in US it's mostly fee-only advisors, versus the traditional commission-based distribution channel.
Yeah, that's a great question. We, I'll mention the name Dan Wheeler again. Dan Wheeler was a financial advisor in the U.S. that started the business with Dimensional. So he was a commission-based, transaction-based broker and was not comfortable with that as an outcome for the client. So he, as he says, as a 40th birthday present to himself, he walked out of his brokerage firm because he felt like the business and the firm, the management, was actually dictating what he was allowed to do for the advisor, or for the client, and that wasn't a good outcome. So he went off on his own, became an independent advisor, with the perspective again that he could be sitting on the same side of the table as the client, make the best decision possible for the client by being independent. And so he did that. He was using Vanguard 500 as a vehicle. He liked the index type of an approach. And then he came across an article in the USA Today newspaper that talked about Dimensional's 9-10 fund, which is now called the microcap fund. And he wanted to have small cap exposure in an index-like fashion. So he came to David Booth and Rex Singfield, the two founders at the time, and offered the idea that they could be in the, we'll call it the individual client business, because up to that point in time, Dimensional was only an institutional money manager, working with the biggest institutions in the world. And they agreed, as long as he was able to control and provide discipline to the asset flow that came to Dimensional. So the perspective at the time was that individual clients were always moving money in and out of the market. It was hot, quote unquote, hot money.
Hot money, yes.
And so they said, we can't have hot money commingled in with large institutional money that's very stable and very static.
Yep.
And so Dan suggested that he would be able to be in a different position than most kind of retail type assets, and he was able to educate and train and discipline the client assets so that they would actually stay in for the long term. And that's where our conference and training program, and really our I guess I'd call it our culture around education and training had began, which was the idea that we wanted to have a different type of outcome. We wanted to have a different type of model. We want to have a different type of result for the end client. And one of the best things, as you know, that you can do as a client, as an investor in the markets, is to stay in the market long term and avoid all the excitement that comes with, or the fear and the greed that comes with the market movement that you see day to day.
Reacting to the noise.
Reacting to the noise.
Actually, you do incur additional expenses where you get in and out of the market, not to talk about making bad decisions. So it's really about ensuring that there's a good investment outcome for the investors.
And very hard. It's the hardest thing for any individual to do, because again, frankly, there's enough information, there's newspaper articles and social media and all these things that are actually suggesting that we need to make a change. And even professionals, I would speak of myself, I'm sure you're in the same boat. We see the news, we have an opinion on the news, we have an opinion on what that might be towards our portoroportfolio. But it takes a lot of discipline to discount that and then stay with what you have in terms of your investments. So that's the real goal and key of all of this. And again, one of the reasons why we work with the independent advisor is, Dimensional or any asset manager out there really doesn't have the ability to go out and translate that discipline and or the education to clients in the way that the advice community can. So that's a very important point.
That leads us very nicely to the next question. In today's world, there's actually a lot of DIY platforms like the robo-advisors and all that. And a lot of people are saying that, that's the demise of the human advisors. What's your view on that?
Yeah, I think it's technology is great. Technology is making things easier for us. And technology can also be a negative if it leads to behaviors that you don't think are a positive net effect towards the client. So I think there's probably a middle ground, and I know there's a lot of really good advisors who have a technology platform that allows them to work with many, many clients and provide a lot of great education and training and so forth, so that there is that discipline aspect built into the technology. That's the key. So I think if it's just a do-it-yourself platform and all of the excitement, the fear and the greed and all the mechanisms that make people transact, are delivered on that platform, that's a problem. But if you have a truly great technology platform that's loaded up with educational training materials and things that are going to keep people focused and disciplined, along with probably some hand-holding from a personal advisor on occasion, then that's going to be a solution that's going to work really well. But it's important because it's, you can have the greatest product portfolios around, but if you can't stay in the market, you're never really going to have a chance to have the kind of outcome over 10 or 20, 30, 40 years that we've seen from really great investment outcomes.
I mean, we always say that, funds are like ingredients, but it's the advisor who knows actually what's the taste, what's the preference, what's the dietary restrictions of, the customer. And then it's the advisor who then put the dish together, put the ingredients together to kind of make a good dish that is suitable for the client. So that's how, at least at Provident, how we look at things. And of course, there's also that saying that, somehow our heart is linked to our pocket. So when,
yes.
there's a lot of market noise,
Yep.
right? And, markets are volatile, we get upset, we get affected.
Yeah.
You mentioned greed and fear, all these are emotions.
Yeah.
And I think that's where human advisors come in to coach, to calm, to be that voice of reason and, calm assurance for the client.
Very, very much. So we always talk about a relationship that somebody has with a medical doctor. It's the same idea that there's an expert who has done a lot of work and research on the topic,
right,
and has a better insight than you might as a patient coming into the hospital, let's say. So same idea with the advisor. The advisor not only knows the client, and I call it is the client expert, but they also have the knowledge in the financial side to be able to review portfolios, make sure the allocation is right. And we used to say that if you're a great chef and you have, something that calls for sugar or for salt, you definitely don't want to put salt in when this calls for sugar. So that's an aspect. The advisors are able to actually look at portfolios, and even something with a label. If a portfolio has a label of small and it turns out it's actually larger than small, then that's a problem too. So advisors are able to kind of work through all of that, and that's a really important aspect. And again, I would reiterate the idea of the independence, the fact that you as an advisor and the advisors, all around the globe that we work with, they are independent. They work for the client. They work in their best interest. And we, as the asset manager, we have to prove ourselves every day, and we have to be able to explain to you why our portfolios might be good for your clients. And then it's a decision at the advisor level to make that decision. So we understand that model. We love that model. We respect that model. We think it's the best model out there, and the best one for the chance of having a great outcome for the client.
Amen to that. Mm-hmm. So, Dave, you actually are a finance professional. You are the co-CEO of one of the largest asset manager in the whole world. So obviously you're very well versed in financial related matters. So if I may ask you a question, do you actually use the services of a wealth advisor?
Yes, I do. I've had a same advisor for 25 years now, 25 to 26 years. Yeah. Yeah. And I think it's a relationship that's very important. I would count that as one of my probably 2 or 3 most important relationships in my life, because I have, 4 kids. I have a wife, a lot of different activities around, wealth management that we're involved in now. And it's just very nice to have a confidant, a mentor, a coach, an expert that either I can have conversations with about an investment topic, or if it's something, on the tax side or estate planning side or charitable giving side, they're there to actually provide ideas to me that I might not have the time and ability, given my role as CEO and role as a father and a husband and so forth. I just don't have time to get to. So to have that relationship is really, really important. The other big aspect is just having somebody with the knowledge of my entire, not only my financial life now, but also just my life in general. And if, God forbid, if I was never here, the idea that these advisors would be there to be able to walk my wife and my kids through everything that they need to understand is just such a valuable, it's an invaluable service that they provide me.
It's like a peace of mind.
Very much a peace of mind. So it's a great relationship. I know so many advisors. When I look back at my 30 years in the business, and I see not only the advisors who have succeeded in terms of their business success, because they've delivered something that's very, very positive to clients, and those clients then refer their friends and colleagues to that advisor. That's how most of them have grown. That's a really impactful thing. And again, going back to 30 years, why did I get in the business? I hope I was able to actually do something that would be impactful and make people's lives better. And you guys do it as advisors. We do it in the asset management space. The combination is really, really a positive change from where we were when I started. And I probably couldn't have imagined that it would have translated into what we see today, which is a really, really substantially great advice business that makes clients just so much better off from what I used to see when I first started with the transactions, the commissions, and the driving into fear and greed, all those things that are negative. It's just been such a great transition to watch.
We hope to see more of that in this part of the world.
Yes.
So, building on that topic of your wealth advisor, what was your selection criteria, so to speak, 25 years ago, before you landed?
Great question.
I know it's a long time ago.
Yeah. Well, my selection at that point was driven a lot on the tax side. So I had just moved from California to Connecticut, and I had to do 2 different tax returns plus the U.S. return, so 3 returns. And I had been doing my own returns up to that time. And then I was in the middle of, I think it was my 3rd year of my CFA, which was a really heavy, study period for me. I think the test was June 1st or end of May, maybe.
Wow, good memory.
Yeah. So I had all those things in front of me, and I was just in conversation with an advisor who we were working with. And he said, yeah, I'm happy to do your tax work for you if that made sense. And so I said, yeah, that'd be great. And so we did taxes together. He did my taxes for probably 5 years. And then that transitioned into an advice relationship. And then I think it's transitioned into a holistic wealth management relationship over the last 10 years or so. And so it's interesting to watch that progression, because I think that is the progression that I've seen on the advice side.
Yep.
Sort of, investment only, then to, called financial planning, and then to this kind of holistic wealth management concept. And I think that's been a transition we've seen a lot of in the U.S. over the last 20 years as well.
Because we're talking about human relationships, it takes time to build. Yeah, and I'm sure he's a very treasured family friend as well, on top of being an advisor.
Yeah, my kids know him. My wife knows him. The kids are now running some accounts through that advisor as well, and getting advice on a lot of topics, college educational money and charitable giving, and so it's been a really fun relationship to develop over time.
It's good to hear that. It's good to hear that. Yeah. Okay. Before we wrap up our conversation today, at Provident, we view money as an enabler for our clients, for ourselves, to live, to achieve our life events. So, Dave, maybe can you share with us what's your view of money, or the role of money, and what it can do for you?
Very good question. I think that is the crux of the whole thing, right? Because it's really about enabling, certain activities. So for me, it's really experiences. I'm not really a big money person. I don't have a lot of expensive tastes. I don't do a lot of things with money. What I do and what I do want to do is I want to spend a lot of quality time with my family. And so that, money does allow you to do those kinds of things, and hopefully is with kids and grandkids and great grandkids, hopefully. You're able to do those things and be able to fund those types of activities. So that's one. I think the other side is just charitable stuff. I think is really important. I think it's how do you give back in some degree? I think it's a big question and an important question. So that's one thing that my advisor and I are talking quite a bit about now, which has been very, very helpful as well. But I think that's it. I think it's again, it's not to have stuff. Stuff doesn't matter to me, but the experiences, good, friends and family and experiences with those people, I think is what it comes down to. So as you get older, as I have, as you start recognizing how important that stuff is.
Yep.
And when you're younger, you're kind of, on the treadmill and you're going fast and hard and you want to do all these things, and you start looking back and it's like, what really made me happy and what really made me tick?
Yeah.
It's all family. It's all friends, it's all progression in life and trying to,
relationships,
and maybe impact and doing things you feel good about. So the dimensional thing for me has always been that. I've never looked in the mirror one day and not felt good about what I was doing, because I felt I was actually doing something that I was positive about, and I could tell my mom that she should do it this way. My mom should have an advisor. My mom should invest in dimensional. My mom is, in my mind, the type of person when I think about the job and the work, it's somebody who's not that bought into financial concepts and hasn't done any study on it, but needs to have somebody kind of translate that into an outcome that's going to be very, very positive for her, and give her that peace of mind, as you said. Avoid the fear, the greed. Be able to stay in the markets and have that affect their lifetime, their retirement and lifetime goals over time.
Okay, thank you, Dave, for sharing with us your wisdom and your insights. We are really very happy to have you with us today.
Thank you, Evelyn. I really enjoyed it. Appreciate the time.
Thank you. Right, we have come to the end of this week's episode. I hope you have enjoyed our conversation. So if you like today's episode, do follow us, follow our podcast, and follow us on social media for similar contents. Thank you for listening, and see you again next episode.
All analysis, views or opinions from interviews, recommendations and other information broadcasted, podcasted or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Provident Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted, podcasted or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Provident Limited.